Cycles editor Peter Eliades, and he looks at something called the sign of the bear. And of course, that he's practically patented the term. But the guy's a genius, and whether you agree or disagree, whether you're bullish or bearish, you should hear him out. Peter, very good to have you.
Neil, it's great to be with you again. It's been such a long time. Indulge me for 5 seconds while I say to you, Neil, congratulations on your great...
Right? I mean, you're concerned about a signal or series of events that are going on that indicate the market could be in for something here. Explain.
This is an incredible pattern, Neil. It's something I discovered in the mid-1990s, and it was almost serendipitously. I was looking over at market data, and I saw a pattern. That pattern was it related only to the advances and declines on the New York Stock Exchange. I recognized that pattern as being something different. I put it into the computer, and I said, tell me when this pattern has happened before. And the computer ran, and it gave me these instances, like the top in 61, the top in 66, the top in 68, and it gave no other instances. And I said, oh, my goodness, this is remarkable. So then I finally got the data going back to the 20s, and there was one signal, Neil, between 1926 and 1961, and that occurred in July of 1929. And I threw up my hands and said, oh, my goodness, we really have something here. The sign of the bear doesn't know what Alibaba is doing or what Amazon's doing or who the new Federal Reserve chairman is or what's going to happen with interest rates.
It's a technical thing. It's a technical thing, right? So what?
Absolutely, Neil.
Tell us technically what it's picking up, what you're picking up.
Okay, what I'm picking up is that on October 5th, we had this pattern. I'll tell you what it is quickly, but I don't want to get too involved. Sure. It's 18 consecutive days where the advance decline ratio on the New York Exchange, advances divided by declines, is either below 195 or above 0.65. So it's kind of a churning range. That churning range turns into, if you get 18 consecutive days and you break out of that to the downside, in other words, with a ratio below 0.65, and you have 2 or 3 days of follow through, that's your pattern. And that's the sign of the bear. It's been incredible, Neil. The last one we had was in September of 2000, right at the top, within a week of the top of the New York Composite Index.
Wow. So in other words, when that happens, and for a sustained number of days, how soon does the bad stuff happen?
That's a great question, and it varies. It's not a signal that says you better settle all today, get out of all your stocks today, or you're in trouble. In 1929, for instance, it took another 10% to the upside in about 5 or 6 weeks. There have been instances, that's the longest you had to wait, by the way, price-wise, to see a move against you. But remember, after moving 10% to the upside in 29, we had a little move of 90% to the downside. Wow. So I would call that a well-timed signal. So that's the type of thing we're looking at here, Neil. One other thing I want to mention, 17-year cycle in the market. If you go back to the inception of the Dow Jones Industrial Average in the 1890s and look at these dates, 1898, important bottom, 1915, right around World War II, important bottom, 1932, important bottom, 1949, 17 more years, a kind of sideways move to an incredible move to the upside, 1966, the next 17 years, a very important top in the market, which lasted for 16, 17 years. The next one was due in 83. It happened 5 months early in 82. The next one due in 2000. I would say that's perfect, especially for the NASDAQ. And guess where we are now, Neil?
Wow.
2017.
Well, Robert Prechter had said, Peter, that he sees at least a 20% hit coming to these markets, which, of course, for C. What do your charts tell you?
You know, if I were to tell you, Neil, and I know why Robert didn't do it either, we would be accused of bear mongering and telling people things to scare them. And boy, those technicians are out again, especially Eliades and Prechter are out there again scaring people, telling them.
Well, people who know your respective histories and respect what the research that goes into it, I don't think they would say that some do. But again, spell it out.
Okay, I'm spelling it out for you. I would say at least as bad a bear market as 07 to 09, at the very least. And that was more than 50%.
Yeah, that cut us in half. So let me ask you this. It's more of a political issue. And I know you don't take sides when you just look at the markets. You're not red or blue. You're just looking at the direction of the green or lack thereof. when you see the president constantly talking about the records in the market and keeps going up, 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 there's a flip side to that, too. You own it on the way up, you own it on the way down, right?
I know. If I could tell Trump, President Trump, I'd bang him on the head and say, President Trump, you have to understand that you're going to have to own the downside, too. And, of course, he might very well think there isn't going to be any while he's in office. And the sign of the bear says something different. That's in Dunlap, California. I crawled out, Neil, and I said, really, people should know this. So I'm out of my cave, and I'm telling you that, Neil. And I have great respect for you for putting stuff like this on the air, because a lot of the media don't want to hear it now. I've written several articles for Barron's. They don't want to hear about things like this. They think that they can prevent bear markets by not writing about them if there's an indication of them.